idea is about using distress risk for tactical asset allocation. So my research question is, how can distress risk be used for tactical asset allocation in Korea? So my background literature is In Search of Distress Risk, which is written by Campbell et al. This paper explores the determinants of corporate failure and the pricing of financially distressed stocks whose failure probability is high. And they use logistic regression to estimate probability of going to bankruptcy. And 4 accounting and 4 market variables are considered. And stocks with high distress probability estimation have a low return and high volatility and high market and small cap beta. And this paper applies the distress probabilities to TAA. So how did you select cases? In Korea's stock market, there are still many individual investors who speculatively invest in distressed stocks for the purpose of taking premium for bearing such risks. For this reason, Korea's stock market is an ideal case to see whether the market anomaly which is explained by Campbell et al. Exists and to exploit the fact as a TA signal. So the kind of individual investors conjecture is simply high risk and high return. So what method did you use to collect data? I used Google, Wikipedia, and Theorem some page, and also I received some refined data from Samsung Asset Management. So data analysis. So with the estimation from the logistic regression, investment strategies are set as follows. First, stocks are listed from lowest to highest according to their predicted distress probabilities. And second, the long portfolios are constructed with stocks whose ranks are from 1 to 50, 51 to 100, and along with their predicted distress probabilities. For example, stock 1 means that it has the lowest distress risk, and stock 100 means that it has the 100th lowest distress risk among stocks during the predicted months. And the first table shows the statistical result of each portfolio. So as you can see, except the least distressed stocks, the risk as the volatility increase, their annual return decrease. And the next. And third, according to the result, I thought 200 stocks with the lowest distress risk and construct a long portfolio with those stocks in. This portfolio includes these 4 long portfolios. And fourth, I compute mean and median of historical monthly average of predicted distress probabilities and set average of the mean and the median as the threshold value. So fifth, if current average of predicted distress probability is higher than the threshold value, and short the portfolio, and otherwise hold the portfolio. So my idea is simply and if this curve is predicted distress risk, and I calculate the threshold value with the historical data, and if predicted this risk is higher than threshold value, I short the portfolio, and otherwise I hold the stock portfolio. So this portfolio and this portfolio use this strategy. So this graph shows the result. The first one is benchmark, which is KOSPI 200, and the first one is using long portfolio only, and this black line is using threshold value only, and red line is using two strategies together. So, shipping hypothesis, the more distress risk, the less return and the more volatility. I found the same result in Korea stock market as Campbell et al. Find in US stock market. As the distress risk increases, the return decreases and volatility increases. Except the least distressed stocks, these propositions are valid. And second, the more overall distress risk, the worse overall market condition. Using the average of predicted distress probabilities, it is possible to predict overall market condition and avoid financial disasters such as global financial crisis in 2008. And conclusion, disadvantage of the investment strategies. The strategy have to long quiescent period, which means during this period, actually yes, we do nothing. So it's impractical. So disadvantage makes the investment strategy impractical, and unexpected short-term events cannot be captured by this distress risk. And advantage of the investment strategies, distress probabilities can be used for portfolio construction. And TAA signals from distress risk prove to be effective in predicting overall market economic condition, and more performance enhancement is available when used with other investment strategy. So from what I learned is distress risk also can be used as a signal for TAA as well as CDS rating, and also learn the market anomaly of distressed stocks. Yes, this is my end of presentation, and any questions?
Okay, thank you, Pat. Next, Kevin.
Sorry, but can I not to be recorded?
Beg your pardon?
Can I not to be recorded?
Oh, okay.
Thank you.
So while I'm turning on my laptop again, hi, my name is Minsan, and I'm the failed presenter from last week. And while I'm doing, while my laptop's running on, after my presentation last week, and I had a chance to meet a person from who has been working in a finance department in a foreign firm called Philips, and he's been working there for more than 10 years. And I talked to him about stock investment, and he's graduate from Sogang University, and he also majored in business, and he has so much background in financial management and investment. But then he said he cannot predict stock price. So he actually got the inside information from his friend, in Kospi enlisted stock, and still he felt very emotional about the stock prices, and then started selling in the short term, and then he was earning a lot of he was getting profits in a few weeks. Then suddenly everything fell down. So from his experience, I learned that maybe that could be background information for my own presentation. That there could be so many factors that decides stock price, but we cannot think about every factor. We could have variables and a lot of factors that might decide the stock price. But I think when you are investing, you need to have your own principle. That's the most important part, so that you're not shaken by your emotion or any movement in any trend in the investment market, in the stock market. So last week, what I lacked was the back. So I'm not going to present everything again because there are some PowerPoint slides. It's actually seen from the last presentation. But what I lacked from last presentation was that I didn't have the background literature. That even though I looked at some literature, but I didn't include any in my slides. So and then I didn't have the proposition, the more X, the more Y. So my investment idea was to build my own index, because my index is not actually a numerical result. Actually, it's more, it represents the my principle on investment. So I actually had to look at some researches, and then I found an essay written by it's not written here, but it's written by Jason Y. It's an essay written in investmenteasy.com, and this person, he actually talks about how portfolios are made by this process, and he talks about how these portfolios can be made by this process, and lots of asset management companies actually use index investment, which is they actually invest on indices that are provided by Morgan Stanley, Russell, S&P, etc. So the reason why they invest in index, there are a lot of reasons why they do that, but one of the main reasons is that they actually can focus on their principle. That be strangled or be trampled or like that by other factors. But index, they actually have their own factors, and they I thought there are so many factors, so why don't I make my own index? So my question was, I can make my own investing index. So I actually used 6 factors: sales growth rate, net income growth rate. That's same from last week. And I analyzed the data from 2009, so that later I could see the profitability from 2010. Yes. So my proposition can be the higher number of positive numbers in 6 factors, I have more possibilities of getting profitable. So that was the if I invested in 2009 according to my index, and I would have gained 18.8% profitability return. So, and my limitations are, of course, I can never predict the exact profitability or stock price. So that was the actual thing. But as I told you before, after I met a person who was unsuccessful in estimating stock price, and I was definitely sure that having an own investment principle is the best way to invest. Even if you might sometimes lose, but still that could be the best way of investment. Thank you for listening to my presentation. Any questions?
I'd like to ask your principle. Do you like profitable or stable way to invest? I just out of curiosity now about your investment idea, but I just wonder which type of
Well, before I prepare for my presentation, actually my principle was buy low, sell high.
Right.
So, but there was the influence from other investment classes before I took last year. But from this year's course, actually, I thought more about being a shareholder. So the reason why I actually had these 6 factors is that these factors actually kind of tell us what kind of company this is, not actually what kind of stock price they represent. And I strongly believe that even if there is no environmental outside influence on the stock price, that these factors can definitely influence the stock price that are reflected. This kind of company's information and company structure, and these things can be reflected into the stock price. And because of I believe in these factors, that the stock price will be reflected by the company's value. It could be said intrinsic value, but to calculate intrinsic value, that's so difficult. So, but my principle is that. So I try to be the shareholder. So in having 6 factors, and if these 6 factors are very strong, that means the company is a very decent, strong company, and that could be reflected in the stock price. And being a shareholder, and my asset will be higher. I do not want to get the capital gain from buying low and sell high. That's my investment.
Among 6 factors you said, what does positive quantities?
Oh, so I actually had to compare with LG, right? I was about to, if you go into Dart or Google Finance, and they and also Naver Finance, and they not only have the data for a specific company, but they also have data for the industry and the data for their rival competitors. So I looked at the industry average in Dart and Naver, but Samsung is a very, very big corporation. So actually they have so many other industries that Samsung Electronics has that belong. So the most similar competitor was LG, because they share similar industries and business units. So I compared with them, and I could see they're far beyond their competitor. That means it's positive.
It means lower than competitors.
Competitor or industry average.
I like ask one question. Can you have a page of your 6 factors? You said just counting number, the number of the positive factors, but I wonder what if the negative effect of just 2 factors is bigger than out of 4 factors positive effect, and I think it would be loss. It would be bad.
That could be the limitation of my my investment idea. But as I said before, we can never anticipate the actual stock price. So if it's something close to, if it's 3 plus and 3 minus, then I will be having other factors. You know what I'm saying, right? So because there are so many other factors, then I can always bring other factors. That could be the modification of my index. But you're right, that could be the limitation of the factors, because we can never know which is more influential than other.
Okay, thank you. Next. Next.
My investment idea is also stocks, like Civic, but I make a lot of change. My question is, how did the stock price goes ups and downs? When we buy stocks, we know that we have average return about 10% a year, and just to do some research before you buy some stocks, because the stock price always goes ups and downs. But over the long time, I think the stock price will goes up. And so my proposition is the more we buy and the more benefits we can get. Then I use my background literature is about Elliott-Wave theory. We can say that everywhere, even in some society, but the most place to say the Elliott-Wave theory works is as a financial market. The wave theory shows how the stock's price goes ups and downs. It's like a wave. We can separate it into 2 parts. The first part is from 1 to 5, and the next part is from A to C. And the first wave is impulse wave, and the second wave is like the corrective wave. I choose the example of Nasdaq composite. As we can say, the wave 1, I will explain the wave 1 to wave C. Let's look at wave 1. It is a beginning of the bull market. Do you know bull market and bear market? In the bull market, the price goes up, and in the bear market, the price goes down. And at the very beginning, the price goes up, and then the second wave, the price goes down, and the third wave is also always the largest and the most powerful one of the third. But at the fourth, it always goes down, and even in the 5, we could say the price goes up. Then in the wave A of a bear market, the fundamental news is also still positive, and the price goes higher a little and then goes down. But we can say over the long run from here, it is November. it is October the 15th. The price is here. It's like, and then over the long time for just 1 month, the price goes up. So. And we can see another example. Fibonacci relationship is a currency chart, but I think it is the opposite one, because at the third time, we could see the price suddenly goes down. So we could, so there are some elaboration about the wave theory. It is this: by using the wave theory, we could pay attention to some of the. Firstly, we could pay attention to you are able to time the entry and catch the big move, and project the end of the trend. Take profit there and do a reserve trade. Sometimes project more than one wave forward and with a built-in timing. A gold press stress reliever. Remember every wave, and when you are within in 5, especially in the 5 and in the 7. After I did the research, I learned a lot because such as using the Elliott wave principle. It is an exercise to exercise improperly, and is someone who is able to identify the market structure and anticipate the most likely next move based on our position within the structures. And by using the wave patterns, you will know that what the markets are likely to do next. But we could not guess the future price. Yes, so remember every wave and where you are, and you can identify the highest price, maybe at recently. But I suggest you to investment over a long time, because my idea is like over a long run, the stock price will goes up. So my limitation is because the wave theory is founded in 1930s, and at that time there are no computers, so there may be cause some variations. Yes. Any questions?
Any question?
So, you told us the Elliott wave principle, but I'm not yet. Which stocks should I invest in?
Which stocks?
You started with your investment managers investing in stock. I saw the first page, but so did I mistake your presentation? I'm not sure.
Which stocks we should I think we should pay attention to some energy, like some energy and some big companies, because in the big some big companies will get more benefits in a long time. We could buy it for now, and then we'll sell it after half a year or then after 1 year. I think for a big firm that will be fit for my idea.
How that
Yes.
the argument you just made is related with the Elliott wave?
Yes.
You just recommend some large energy stocks, right? And why the stocks are attractive given your theory, actually given the theory about Elliott wave. You have to back up, you have to justify what you just said with your theory.
It's the best time we could sell is in the fifth point. But we couldn't guess when is the fifth point, so we could say after a very long time, like this, we could guess then goes down, and then the next goes up, we can sell it. I think after we after the bear market, we can wait for the new bull market and to sell it. I think it's the best time to sell it.
Okay. How about other stocks? Non-energy stocks.
Other stocks.
Okay.
For
Where is
this,
your data analysis?
Yes.
Where is your data analysis?
Yes, I did it. I think, yes, this one is my data analyst because.
So one is X and one is Y. So more X or more Y. It's X and one is Y.
The more we buy and the more benefit we could get.
Okay, so in your data analysis, what is X and what is Y?
Because over the long time it goes up, so the more we can buy at this time and the more we can get benefit at this time. So this is the more the X and the Y.
No, that is not correct. Okay, anyway, thank you. Unfortunately, you failed again. But don't worry, you have average score because there are other students who did not even make presentation. Didn't attend this class even after fail. I'll think about whether I will give them a chance or not. I'll think about it. And then would I your presentation, please? Okay, you did fail. Now, presentation is very important. It is like 1/3 of your grade, almost. Actually, 1/4. Okay, almost 1/4.
25%?
Yeah, almost. I think so. I cannot exactly remember.
Perfect presentation isn't it more than 10%?
Just a moment, let me check it. So I have a probability. Actually, I have. Okay, 5-page presentation. Okay, so 10%. 10%. Okay, reading presentation. Oh, okay. So all your presentation 20%. Okay. So 10% of your grade. So it can make you change your side plus minus. So if you have A plus, which means that, and you ruined your presentation, you are likely to get A minus. And if you are A and for other performance and ruin your presentation, you are likely to have a B plus. Okay, let's continue our discussion about option, about the brain teaching problems about option. Then let me briefly review our previous content. There are American options are more valuable than European options. But in some cases, there are cases such that American option and European option have exactly the same value. When is it? Can you remember? Alright, American option means you can exercise anytime you want. And European option, you can exercise your option only at the terminal. Okay, only at expire. So, since American option can exercise anytime, therefore they can exercise expiration date as well. American option should include European option as a special case, so American option should be more valuable. But in some cases, they have the same value. Why is that? When they have same value? At the maturity, yes. Okay, that is first obvious answer. At the maturity, right? Because American option has only one chance of exercising now, and European option as well. So they should have really extend that. What else?
When investment thinks waiting to exercise the option is better.
Okay, yeah, that's a good point. So when an investor think waiting is always better than exercising right now, means that they have to wait until the end. Right? So in that case, the optimal moment of exercising option is expiration date, and European option can be exercised at the expiration date as well. Therefore, optimal value of American option should be equal to the value of European option. Therefore, the value of those two securities should be same. Okay. Yeah, then when the value of waiting is always greater than the value of exercise, when those cases arise,
Because exercising the option doesn't giving us some kind of dividend or profit.
okay, so exactly when. So, it's actually the American option, American call option, okay, have when underlying asset has no dividend, underlying asset has no dividend, American call option we have the same value from American call option should the value of American option should be same to the value of European option. So it means that the American option it does not have any dividend stream will be exercised only at the expiration date, which means that waiting is always more valuable than exercising in the case of American call option without dividend. Okay. So what is the intuition about that? Angelica. And I explained 2 weeks ago.
Oh, is it like with apartments you explain?
Beg your pardon?
Is it with examples of apartments?
Apartment, yeah, something like that. Yeah. Any volunteer? So anyway, basically the intuition is very, very simple. Okay. So without any dividend, which means that there is no benefit of holding the asset. Right? So since there is no benefit of holding the asset, if we exercise the option right now, you hold the asset without any benefit, but you have to pay before. So you lose opportunity cost of the interest. Right? On the other hand, if you wait, then you don't have to have the asset. it doesn't matter because there is no benefit of holding like that. But instead, at the end of the day, once you exercise, by waiting, you can pay later, right? You can pay later. Okay? Therefore, the optimal moment of exercising in this case is expiration date. Therefore, American call option should have the same value as the European call option when there is no dividend on the underlying asset. Next, Theorem 4. Okay. So to remind you, F is American option. Okay. So American call option. American call option is a rationally determined warrant price. If it is a rationally determined warrant price, then F is convex function of its exercise price. Do you know what is convex function? In economics, we have a convex function around in many cases.
Round.
Very good.
Convex. I think convex means roundedly.
Yes.
Curved.
Okay, you already learned. Actually, you didn't learn calculus in high school.
Like indifference or continuously increasing. And,
Continuously increasing what?
more slow.
Way more slow. Yes, that is kind of right, but not always.
Convex function like exponential, negative exponential function.
Exponential function is convex function. So convex.
It's very hard to explain. Convex.
It is actually very easy to explain. Let us choke. So I don't have any white or yellow chalk. So convex function is simple, like this, or something like this. Okay. So when you look at the curve from the below, okay. So there is, okay. When you look at the curve from the below, if it is convex, it is convex function. Isn't it very simple? Okay. So the more mathematical, that's also mathematical definition. Mathematical definition of convex function is you pick 2 points in the curve. Okay. Point here and here. Okay. Pick 2 points and connect the 2 points with straight line. Straight line. Okay. In this case, this straight line is above this original curve. Right? And this is convex function. Okay. So again, 2 points and connect and check whether this segment is above or below the line. So therefore, this kind of curve is concave function. In this case, if you pick 2 points, then the segment is below the curve. So it's concave function. Of course, more intuitive, more easier definition is you look at the curve from below, and if it is like a dome, okay, then it is concave function. So in economics, convex function and concave function happens a lot. Okay. In economics, what is the concave? When a concave function arises, what is the example of a concave function in economics? You are from economics.
Right. I'm just coming up with some word to.
Yes.
The product function of fund can be okay.
Yes, that's right. So something like this. The production function like FKM, right? So let me make another definition of concave function. So the segment is above actually convex function, then it is convex function. Another more convenient definition is like second derivative. Okay. If second derivative is positive, then it is a convex function, and second derivative is negative, then it is concave function. Okay. So in economics, there is a when economics, in this case, so output is the function of capital and labor, right? Function of capital and labor. And if we increase more capital, then production should increase, right? If we put more labor, okay, the production increases as well. But I mean, if we put more and more capital, actually the marginal effect about the capital or marginal effect of labor will decrease. So in this case, this is negative. This is negative. And actually there is actually it is two by, if we have two arguments defining convection function is we have to have a Hessian matrix, so then we have only one argument. Okay, one argument. So if we work hard, okay, so it is production function, so usually maybe it is your grade. It is your grade. Suppose it is your grade, and L is your studying hour. Okay, studying hour. So the harder you study, okay, the better your grade, right? But the thing is that if you increase your study from like 0 to 1 hour, 0 to 1 hour, then basically you have some point like 0 point and like some 10 points, something like that. So very important. But if you work like 100 hour, okay, and work like 101 hour, right? The marginal effect of this 1 hour will be much smaller than this marginal effect of 1 hour, right? That is intuitive, no? So 0 to 1 is maybe too extreme. So 10 to 11 hours, okay? 10 to 11 hours, okay? So if you work like 100 hours and you are likely to get A, and even if you work just 1 more hour, maybe it is very hard to increase your grade from A to A plus. Okay. But in this case, if you work 10 hours and work 1 hour more, then the marginal effect will be great. Okay. Which means that the second effect will be negative. Okay. So your grade increases with your labor, but increase at decreasing rate as your labor increases. So this is negative, so this means production function is right. So this first derivative is positive and second derivative is negative, so it means that the grade as function of your studying hour would be like this. It always increases with the amount of labor, but increase at decreasing rate. This concept. And about concave function, okay, so it is concave function, okay, concave function. So production function is a concave function. But in economics, we also have other cases of convex function, okay. Can you recall any convex function in economics? Did you take economics class? Microeconomics? No. Indifference curve is kind of, it is we don't actually it is often convenient to assume concave function for indifference curve, but it doesn't have to be. Indifference curve can be quasi-concave function, which is more difficult one, so I don't want to mention that. Oh, by the way, I think every student who major business should take microeconomics and macroeconomics as well. So apparently you didn't take that. Okay, how many students took microeconomics class here? Just 2. That's not good. How about macroeconomics? Means that you are business, right? Yes. So you are the only business student who took both classes. That's not good. We have to change the rules.
It's not mandatory for business.
Yes, I mean, it should be mandatory. I don't know why.
Yes. You should.
Analysts who are interested in finance should take both micro and macro, and international finance and international trade. At least those 4 credits that we should take. Okay, anyways, in economics, usually cost function is convex. Okay, the cost function is convex. So suppose this is cost of producing output of the Q. Okay, Q is the cost. So Q is the output amount of output, right? Amount of iPhone, something like that. Okay, and CQ is the cost of producing some amount of iPhone, something like that. Or it is, if Q is so in this case, working hour is equal. So maybe we can imagine working hour as your output. So output from your body or brain, something like that. So study, amount of study is your Q maybe. Amount of the study. Amount of studying. Amount of studying is Q, suppose. And then C is cost of studying. So what will the cost of studying? Since studying is fun, okay, so there should be no cost. So suppose it is costly, so it might like pain of studying, something like that. Pain of studying. So to suppose studying is a pain, okay, the more study, okay, the more painful you are, right? So CQ should be positive, right? The more study, the more painful. But thing is that suppose you study from 0 to 1 hour, okay? Suppose you don't study at all, there is again quick, there is always idiosyncratic things happen when things are 0. So suppose you study 1 hour and increase your study 2 hours, okay? Then of course you feel more pain of your study. Now suppose you increase your study from 10 to 11 hours, right? So the plausible argument would be maybe increasing your studying from 1 to 2 hours is painful, but it is maybe less painful than increasing your study to 10 to 11 hours. Right? In this case, maybe still you can sleep like 8 hours or 7 hours, but in this case maybe you have to sacrifice your sleeping time. Maybe this is more painful. Right? So therefore, studying is costly, okay, but as the amount of studying increases, it becomes more and more painful. So producing one more unit of iPhone from 10 iPhones would be maybe nothing, but producing 1 million plus 1 output, 1 iPhone from million iPhone would be more costly because there is a capacity limit in the plant, something like that. So in this case, in economics, cost function is usually assumed as convex function. Anyway, in option pricing, this type of convex concave function is also very, very important. In this case, the call option price, okay, call option price is convex function of its exercise price. This actually is convex function of its exercise. The option price is convex function, then it will be looked like this, or either looks like this, or either looks like this. So in order to show that option price is convex function of exercise price, what we have shown is that basically we pick 2 points in the line and connect them, and we have to check whether that line is always above the portfolio. We pick the 2 options here and here, and we have to check whether the portfolio of option is more valuable and the option price is intermediate exercise price. So to prove convexity, we must show that if E3 is weighted average of 2 exercise price, okay, then basically the option value with intermediate exercise price should be less valuable than portfolio of option with different exercise price. Okay. So this is the definition of complexity. So once we show this, then option price will be complex. And it is actually easy to prove. Okay. So we do so by dominant argument similar to the proof of Theorem 1. So let portfolio A contains lambda 1 with the exercise price E1 and 1 minus lambda warrant with the exercise price E2, where by convention, suppose V2 is greater than E1. Okay? It doesn't matter, E1 can be greater than E2, but without loss of any generality, let's assume E2 is greater than E1. This is what and then let portfolio B contains now one warrant with the exercise price E3. E3 is again intermediate value of exercise price. Okay, and now we can compare the value of the portfolio at the terminal state. So if S star is the stock price on the date of the expiration, so stock price at time BT at the terminal, okay? That by the convexity of max, the value of portfolio A should be greater than value of portfolio B, right? At the terminal state, as you know, at least we know the option price is convex function at the terminal state, right? Because at the terminal state, suppose this is the exercise price, and then suppose the option price, and for given the value of S, so this is the point when E is greater than S. Right. Therefore, so this is S. So in case of now, I draw the value of option as a function of exercise price. Right. So the core option value will be ruled like this. Right? I mean, it is slightly different. We usually draw the value of core option as a function of S, and it looks like this. But now I draw the value of the core option at the maturity with the function of the exercise price. So if exercise price is greater than stock price at the terminal state, then option is not exercised, so value is 0. If exercise price is lower than option price, then we exercise option and we get the profit by the difference of the exercise price and option value. And if our exercise price is 0, then the value of option should be the stock price itself, right? So it will look like this. And this is the convex function, right? So if we pick 2 points here, then the line between them is always over this terminal value function. Right? So at the terminal state, basically the weighted average of these two option values, this is greater than this one, right? So basically, this first equation means the value of this line. Then the second equation, well, this one is some value over here, right? Of course, if we pick two values like this and this, then the both portfolio would be exactly the same, value. But some case we can pick those 2 points, then the portfolio value is greater than the value of portfolio A will be greater than portfolio B. Therefore, value of portfolio A cannot be smaller than value of portfolio B. Right? So at the terminal state, since the option price is convex function of exercise price, looks like this. Portfolio value of portfolio A should be always greater than value of portfolio B. And importantly, as to avoid the dominant, the current value of the portfolio B must less than equal to current value of the portfolio A. Right? So at the terminal value, this portfolio value is greater than this portfolio A. Value of A at the terminal. This is portfolio B, intermediate value. So Since at terminal state A is more valuable than B, so current value of A also should be greater than B. And in addition to that, okay, since nowhere in the argument is any fact involving tau, okay, time to mature is irrelevant in the proof, right? So time to mature is not important. Therefore, the same result would obtain if warrant in the two portfolio were exercised even prematurely. So tau doesn't matter. This proof is independent of the time to maturity, which means that it doesn't matter whether the portfolio is exercised prematurely or not. So A should be always at least more valuable than portfolio. So this is our proof. Any question? So we just proved that option price is convex function of exercise price. We will see this important later on. And second, now small f is European corruption, right? So if European corruption is rationally determined European world price, so if price is rational, then when E1 is smaller than E2, then we have this type of equation. So let me write down P tau, okay? To remind you, P tau is the value of the pure discount form. So it's the value of contract that give you $1 at T tau times later. So this E2 minus E1. E1, and which means, and send E2 E1, okay? That is E1, then basically we prove right? Right? Actually, derivative with respect to the exercise. So if we can prove this one, we prove this one, right? So this is a special case of this one. We divide each side with E2 minus E1 and send E2 minus E1 close to each other, then this part should convert to derivative. So now suppose and let's prove this part, and this part, proving this part is also very easy, okay? We use the same technique, we can just apply a portfolio argument. Again, first, actually this part is obvious, right? This part is obvious because we know option value, correlation value is the decreasing function of the exercise price, right? Decreasing function of exercise price. So this part should be obvious, right? The higher exercise price, the correlation, we have the low option value. So this part is obvious, so let's prove only this part. So the right hand inequality follows directly from 6. Okay. So the right hand side is this one. So we want to show only this one. It's so hot. So A contains water. The left hand inequality follows from the dominant argument. So suppose portable A contains water to purchase the stock at E2 and E2 minus E1 bond at price P tau per bond. Okay, and now next portfolio B contains the water to purchase stock at E1. Okay, so basically portfolio B is the value of this one. Okay, portfolio A is the value of this part plus this part. Okay. So suppose S star is the stock price on the expiration date. The value of the terminal value of the portfolio A is of course, okay, it is the value from option position. And since we have E2 minus E1 present value, so at the terminal value, the value should be E2 minus E1. And the value of the portfolio V would be max 0 at star minus E1. So we know, okay, this part, okay, is always greater than this part. It is easy to check, okay. So this one is always greater than this one. Therefore, okay, therefore portfolio A, okay, should be always greater than portfolio B, okay. So which means that the value of the European option, which is the value of portfolio B, should be less than this part, value of the European option. With the exercise first E2, and then present value. So basically 2. We move this one here and we move this one. We move this left hand side. Okay. And then once we prove this, then of course if we send this E2 minus E1 very close to each other, then we prove this part. Any question? And for American option, okay, again let's assume that there is no payout and there is no change in exercise time. In case of American option, we have similar cases, but since we can exercise American option anytime, we don't have like key power over here. So we have only this equation. Okay? So this is the relationship about the European option, and for American option, we don't have this. Okay, because we can exercise American option anytime. Now let QT be the price per share on a common stock at time t, and PQ tau is the price of warrant to purchase one share of the stock at price EQ, or on or before any given day tau, years in the future, when the current price of the common stock is Q. Okay, and then we have very important theorem about option price. Suppose K is the positive constant, and suppose QT is K times of underlying asset, and EQ is K times of some asset price E. Okay, then basically the value of the core option is the underlying Q and EQ. Q is K times of underlying asset, EQ is the K times of asset price. Okay, so we increase Q and E both K times of the original, then the value of option would be K times of this asset. So if we have option about 2 shares of the Samsung Electronics at 2 million won, okay, the value of option would be exactly 2 times of call option for 1 unit of the Samsung Electronics at 1 million. It sounds strange, but this hold, this should hold. By the way, this type of argument is for this kind of function. Okay? Okay, so it means option is a special class of this type of function such that. Okay, so suppose y equals x1, x1, x2. Suppose we have a function f, which is a function of the x1 and x2. Okay, so this means that if we increase kx1 and kx2, so if we increase x1 and x2 k times, then suppose we have looks like this. This is the this class of option. This class of function f is called homogeneous of degree 1. Degree 1. Suppose we increase x1 and x2 equally by k times, and it increases like n times. In that case, we call this type of function as homogeneous with degree n. Right? And interestingly, option is homogeneous with degree 1. This is actually a very important property, and it actually simplifies one of our analogy. So let me give you some examples. So suppose y equals x1. Okay. And suppose fxy is simply x plus y. Okay. So if f is simply x plus y, then what kind of a degree does it have? So if we increase x and y k times, then because it is kx plus ky, right? Which is kx plus y. So therefore, it is homogeneous degree 1. So linear function is homogeneous degree 1. And suppose x plus y, xy is simply x multiplied by y, then what kind of degree does it have? It is 2, right? So if we increase x by k and y by k, then f increase by k squared. So it's the second degree of homogeneous degree 1. In the economics, we learned the Cobb-Douglas function. So Q, okay? Suppose assume production function. Q is LK, okay? Output is function of labor and capital. And in economics, very popular. One is FL, alpha, K beta. Okay. So this type of function is Cobb-Douglas function. So this is called Cobb-Douglas function. So in case of Cobb-Douglas function, what kind of degree would I? In case, so suppose we increase L and K by some constant time, some small k times, how much will Q increase? So suppose we double up, okay, L and K, okay. So suppose we increase amount of the labor and capital to the output 2 times, then how many times does the output increase? Did you finish your? So if we double up L and K, if we double up our input, how much does output increase? 한번에요. So okay, KL, okay, since we have 2K, so instead of K, let's make C, okay. Suppose we increase or decrease labor and capital, it is the same proportion, like C times, okay. Suppose we put C times of L and K, then see what's going to happen. A, CL alpha, CL beta, right? and which is basically oh, I think I made a mistake. Sorry, I think I gave you wrong problem. So anyway, you see alpha plus beta, A and alpha, K beta. So it is C alpha plus beta, okay, C alpha plus beta of F, L and K, okay. So yeah, so actually it is a degree of alpha plus beta, okay. So yeah. So if we double up our input 2 times L and K, then our output increases like 2 to the power of alpha plus beta. So anyway, so co-dominant function in this case is degree of alpha plus beta. Homogeneous with degree alpha plus beta. So when you say the interesting property is when alpha plus beta is greater than 1, when alpha plus beta is greater than 1, what happens? So if we increase output, if we increase our labor and capital 2 times in the production, will our output will increase more than 2 times or less than 2 times? More than 2 times. So it is very interesting case. So if we increase all our input 2 times, then our output increase more than 2 times. So this kind of case in can be called this, and then there is economies of scale. So we scale up our product. Actually, we can produce more and more, right? So if our cost of labor and cost of capital is constant, then as we scale up our facilities, our output increases more and more. So our profit will increase even faster, right? So actually, the larger our firm is, the more competitive it is in the market. So there is return in economy of scale. Okay? There is increasing returns to scale, okay, in the product. Okay? And of course, more practical, actually more realistic case would be alpha plus would be less than 1. So if we increase L and K 2 times, usually output doesn't increase that much. Then it is decreasing, called decreasing distance scale. When alpha plus beta equals 1, it is called constant distance scale. If we scale up our input 2 times, our output increases by 2 times. So it is increasing return scale, decreasing return scale, and constant return scale. I think this is very important. Everyone should have learned this long time ago. In your first, okay, when you were a freshman, I think you should have learned this. You learned this in your first year, right?
Second semester.
Second semester. Okay, anyway, first year. Okay. It doesn't have to be first semester. I think it is very important. In finance, this is kind of a principle very important. Anyway, in case of option, okay, option is similar to constant return scale. Okay, if we double up underlying asset and associated price, that becomes exactly 2 times. So this is very convenient. So since option price is constant return scale, homogeneous degree 1, which means that we can normalize stock each other, and we can compare the stock Actually, we can normalize. Somehow we can normalize option value, and we can compare options each other. Right? Because each option have different specification, right? Different exercise price and different underlying asset with different stock prices, right? But since their homogeneous degree 1, so basically it is possible that if we divide every option by some constant, okay, the option value will be right. If we divide underlying asset and exercise price with some constant, option value will be exactly divided by the constant. Right? So this allows us to normalize option price and compare with each other. The most common way of normalizing option price is normalize option price with the exercise price. Yeah, so in this case, suppose this K is 1 over E. Right? So if it is 1 over E, then basically it goes inside, then simply this part becomes 1, right? And this part will be S divided by E. So it means that basically we can compare all options each other, in a way that divide stock price with the exercise price and assume exercise price as 1. Then every asset that we give the same exercise price, which is 1, it is easier to compare each other. And the stock price, in the case, stock price is simply multiple of exercise. Actually, we use this property already when we driving Black-Scholes formula. When we driving the heat equation, when we drive heat equation from partial differential equation, actually we already use this property. Look at your proof again, and you will see we use this one already. Right? Did you find it? We normalize stock price and the exercise price. Okay, let me see.
Before heat equation? Or after?
Yes, before heat equation. Okay. P for the exercise price. So basically this part, right? So this part. So X is underlying asset. So we express underlying asset with multiple of C. Okay. So C star is the exercise price, right? So we express basically underlying asset as a multiple of some constant EH. Okay. Right. And by using that argument, basically we exercise one price and we put C star in front of it. So in this case, what we usually do in this case, we put E to basically by E each side, and so exercise price becomes 1 and multiply E here. So we can put E in front of it, right? Anyway, we already used this property when we derive the heat equation. And the proof of this one is also very, very straightforward. Okay, we can simply check our terminal condition. Okay, terminal option value will be max of 2 minus E, right? Which is exactly homogeneous degree 1, right? If we multiply this one by K, this one by K, some constant, then we can put this one outside, right? So this one should be equal to this one. Right? Q star is Kx star and EQ is K, right? So this is K multiplied by S star, K multiplied by E. So we can put this small K outside of this, right? So because at the terminal state, the expression rate, these two relationships hold. And then this is fully independent of time maturity. This relation should hold today as well. Therefore option price is homogeneous degree 1. Any question? So yeah, hence we can always work in the standard unit of exercise price 1. So we can always standardize option where the stock price and work price are quoted in the unit of exercise price by choosing K equal 1 over E. That's what I told you. Not only does this change of the unit eliminate a variable from the problem, okay, but it is also useful operation to perform prior to making empirical comparisons across different options, where the dollar amount may be of considerably different magnitude. Any question? I think do you need any rest, or you can just continue and finish the class a bit early? You need a break? Okay, so why don't you take 15-minute break? So let S-I, so we have Sanskrit I everywhere. It is a valuable word like current stock or form I. Okay, this is about stock I. So current stock price is SI, tau I is time maturity, okay, and EI is the exercise price for form I. So we need an assumption, which is actually very realistic assumption. So suppose that the initial stock price, the stock prices are all same, and then time to maturity is all same, and then exercise price is all same. Okay. So for every stock, so we have a different stock with different subscript. But suppose when we have an option, we normalize those companies somehow such that we set exercise price, time to maturity, and all same. But since they are different forms, okay, they will have a different distribution of stock return in the future. Okay? But suppose that they have identical distribution. Okay? Suppose they have identical distribution, then we assume that the option price is all same. Okay? So suppose there are two stocks for Samsung and LG. There are two stocks. There are two options. Okay, suppose we have two options. One is option about Samsung and another option on LG. And although they have different option about different funds, suppose they have the same underlying value. So they have $1 million. Okay. So Samsung and LG, and let's say exercise price will be $1 million. And time to maturity 1 year. Everything is same. So option specification is basically the same. The only difference is between Samsung and LG. And next, let's assume that both Samsung and LG have the same distribution in the future. Okay? People expect, although they have independent distribution, but they are independent of each other, but we can maybe assume that they will grow like 10% next year and others will be 30%. Okay? But they are independent. In that case, okay, we assume that option prices are same. Okay. So the only so basically this assumption means that from the point of view of the option holder or warrant holder, the only identified, okay, the only important feature of the common stock is distribution of the return. It doesn't matter whether it's LG or Samsung or only the distribution of the return. Which is actually very realistic. It should be actually evacuation efficient. Okay. So it means there is no brand effect. Okay. There's no brand effect on the option. Anyway, define ZT. Okay. ZT to be the one period random variable return. So it is return per dollar investment in the stock. And then therefore week Z tau is the return up to the return for tau period of time. Return until the maturity. Then we have very important theorem like this. Suppose we have option about n component and initial stock price is also set all same. Okay, and let's define some underlying asset about n plus 1. Okay, immediately, so let's define n plus 1 return. Okay, as the weighted average. Okay, weighted average of the return of the tau of existing n underlying. So it is weighted average. So sum of this weight is the 1. Okay, and it means that okay, we have an option such that initial price is as S and other, but its return of the time tau is weighted average of the return of all other underlying asset. So the value of that kind of option is smaller than portfolio option, with portfolio weight is lambda, and each portfolio is underlying as this individual asset. So basically we create so there is n type of underlying, n type of option and underlying, and we create basically n plus 1, okay, one more option such that in that option the initial price and time to maturity exercise price is all same to the other option, but its return up to time t is generated with weight average of return of the other asset. Right? So basically this is option on the portfolio basically. And basically it's a portfolio option. So it means that option on portfolio is worth less than portfolio option. Right? Which means that usually in investment class we learn diversification is good. But at least in option, okay, maybe diversification is not that good idea. So we don't want diversification in underlying. Okay? Instead basically we want prefer undiversified underlying, and we simply want to have a portfolio of options. So diversification in underlying is not a good idea in case of option. So again, the proof is simple. Okay, it is the same as before. So by construction, one share of the n plus 1's first security contains lambda I share of the common stock of the firm I, and by hypothesis, the price per share S plus 1 equals basically portfolio of weighted average of other underlying assets, and other underlying assets value is the same. So basically, the initial value of newly created option for underlying, okay, for underlying is the same value. And then let the portfolio A contains lambda I warrant on the common stock of the firm I, so that I is equal to n. And that portfolio B contains a warrant on the n plus 1 security we just created. Is the portfolio option on the portfolio, n plus 1 security is simply portfolio with weight lambda. And then let SI start denotes the price per share of the common stock of I firm on the date of expiration. Okay, on the date of expiration. Therefore, I definition for our terminal value of the portfolio, underlying portfolio is basically Sn plus 1 star, which should be equal weighted average of the terminal value of all the others. The Y constant we should work. Okay. And then therefore on the expiration day, the value of the portfolio of A, which is the portfolio of the option, would be look like this. So this part is terminal value of individual option, and we have lambda amount of coefficient for construct portfolio option. So this is terminal value. And then about the option about the portfolio, since terminal value would be look like this. So the second portfolio would be terminal value is max 0. And then we know by the complexity, weighted average, by the complexity weighted average is should be greater than the average of weight. Okay. This should be smaller than this one, right? Therefore, this is as a terminal state expressed, this portfolio A is greater than portfolio B, and the price of the value of the portfolio A should be greater than value of portfolio A, right? Again, this is independent of the tau, it's time to maturity, therefore it should hold for any tau. So it holds for American object. So we prove that it is option on the portfolio, it is portfolio option. So diversification is not a good idea if you have an option. More clear diversification at the underlying is actually not a good idea. So loosely, Theorem 7 states that a warrant on a portfolio is less valuable than a portfolio warrant. Yes, thus, from the point of view of the warrant, value of diversification hurts. Okay, warrant value diversification actually hurts. Okay, as we just do. So in the next corollary, this is actually more straightforward. So in the hypothesized condition of Theorem 7, we just discussed before, and if the Zi tau is identically distributed, then Fn plus 1 SE is less than Fi SE. Okay. So from the point Theorem 7, since we have this relationship, and by hypothesis, Zi are identically distributed, and so are Zi tau. Okay, therefore, for all option values should be same. For option value should be same. And since weighted average is 1, so these are all same, so we can move this one outside. So this is 1, so very, this should be greater than Fn plus 1. Anyway, Theorem 7 and corollary suggest that the more general proposition, that the more risk is the common stock, and the more valuable the warrant is. Okay. Right? So basically, diversification basically reduces the risk. If you do the diversification, and because of diversification with diversification effect, the underlying, if we have a diversification on the underlying, then the risk of underlying will be decreased. But actually that kind of diversification hurts the option value. Therefore, which means that as the risk on the underlying decreases, so basically we can conjecture that as the risk of the underlying decreases, then the option value will decrease as well. But actually, this is kind of easy to lose argument, but in order to have more accurate, rigorous proof about the relationship between risk and option, basically we have to have a good definition about this. Okay, I think I explained to you multiple times why risk is good to option, right? Intuitively, right? Can anyone repeat what I told? Could someone explain why? I mean, we briefly shows that show the relationship between diversification and option value. But I mean, more intuitively, before we go into the deeper about the concept of the risk, can anyone explain intuitively why option becomes more valuable as a risk increases?
That just volatility of underlying asset. When the price of underlying asset drop, then we can just give up, right? But when the risk is pretty high, it means we can enjoy the risks part with option. And when diversified underlying asset is in, and as the risk is diminished, the part we can enjoy will be diminished. And I think that's why the diversification is damaging the option value.
Okay, that's good. Ranghack, can you repeat why risk is bad? for option. And you are running away. I'm about to come.
I have to call because it's 11:30. I have to make a call before the Office of International Cooperation go for lunch. I'm sorry.
Oh, okay. Okay, if you come back, I'll ask you a question.
Yeah.
So, okay. So, why risk is good to achieve? Usually we hate risk, right? But risk is actually good if we have option. Okay, Yongwon, can you explain about it? Briefly, okay? So listen carefully, okay?
Risk itself is just volatile, not that it can rise or drop. When option is coming as a risk, we can enjoy just the good part of risk, which means the underlying asset price go up, because we can give up the right, the option when the underlying asset price go down. So with diversification, as the risk goes down, and it means the part we can enjoy with the option and risk is diminishing. You understand?
I think it is actually one of the most important properties of the option. So imagine you have two suppose there is two suppose you have two games in one game. In two games, we throw the coin. So in game one, okay, if you throw the coin, there is a head, you receive $1 million. And then tail, you lose $1 million. Okay. And suppose we have game two. In game two, you throw the coin, say, and if there is a head, you make $1. And then if there's a tail, you lose $1. Which game will you play? Beg your pardon? Game one? Why?
I put 2 cards.
No, you have only one coin. One coin for
one
each
coin.
game. This is game one and game two. Okay? And you draw the coin, maybe it has head or tail. In head you make $1 million and you lose $1 million. And in game two you make $1 and you lose $1. Okay? You draw the coin, head and tail. Okay? Which game do you like? This one or this one? You still like game one? Okay, I mean it is possible. Okay, it is possible. Yeah.
But game 2 has a little risk, so game should be safe.
So you like this one or this one?
Game 2.
You like game two, right? So most of people will like game two. So of course, if there is head, if you make $1 million, it is very good. But again, there is 50% chance you will lose $1 million. Right? That's very challenging. So people will not usually play this game, right? What's the point of taking so much risk? Right? So if we have to choose one of the two games, then we will choose this game. Okay? And the reason is people are usually risk averse, right? People usually take risk. So if we have to choose one of them, basically we want to choose these two. Game two, right? Now suppose we have an option. Option such that option on this game. We have an option on this game such that now in that option exercise price is 0. Okay? We have option such that exercise price suppose we have exercise price $1. Okay, so there is option on game 1, there is option on game 2, and both of them exercise price is $1. Okay, now which option do you wanna have? Still game 2, why?
Because exercise prices are
Okay.
choose one. There are a lot of these.
Okay, so if exercise price is 1, okay, actually exercise price $1 is not interesting. Let's make exercise price $0.50, 50 cents. Okay, so exercise price is 50 cents. So when exercise price is 50 cents, when there is head, okay, what will be the option value?
That's 1.5.
Okay, so again, now we have option. So it is underlying now. We have option. Okay, now let's underlying price at 0.5. When head, what should be the number here?
1.5.
1.5. Okay, what should be the point value here?
1.5.
Beg your pardon?
1.5.
Here it is 1.5.
Minus 0.5.
Here the value is minus 1.5. Why? So now you have an option only. Okay, you don't have underlying. You have option on the game. So it turns out that you have a tail, okay? Then you are about to lose minus $1, okay? So if you exercise option, then you have to pay $1.5, and if you exercise option, you will have minus $1.5, right? If you exercise option on the underlying, then underlying value is minus $1, and again you have to pay $0.5, right? So you value of your position is minus 1.5, right? And if you don't exercise this option, basically, okay, your pay should be 0, right? Because you only have option on this underlying, and simply you don't exercise option, and you don't have to pay anything, and you have no position in the underlying, right? How about this? Okay, about game 1. Okay, what's gonna happen when there is head? Right, so if you exercise the option, then you will get $1 million. Okay. So you will get $1 million. Okay, and you have to pay $0.5. Okay, so $1 million minus 0.5. Beg your pardon?
Half of the million? And
No, not half a million. It's $1.5.
Oh, $1.5.
So it is $999,999.5. Okay. And if it is 10, basically you will lose $1 million. If you exercise the option, then you will have $1 million minus $0.5. So, but if you don't exercise the option, your value will be 0. Okay, so which one looks better, this one or this one? Beg your pardon? This one?
Yes.
Yeah, so this one is better, right? Because when there is a tail, basically you will pay with zero. But when there is head, you will make enormous amount of money and you will make pay over here. Right? So and for option, okay, because there is no downside risk, okay, you can eliminate downside risk. So actually risk asset will be better. Okay, so it is basically intuitive. So for option, okay, so if underlying risk we are happier. Okay. So it is intuitive argument, but actually in order, actually we don't have enough time. Okay. So in order to introduce risk, actually we need a more, how can I say, rigorous definition of risk. And economics, okay, this is definition of risk in economics. In economics, when you say security 1 is more risky than security 2, if Zi is sum of Z2 power and epsilon, consider if epsilon is random variable with the property of risk. So when one asset is riskier than the others, it is when we want to make one asset riskier than the others, one idea is simply we can add a random variable to the other asset, such that the random variable has mean zero. So mean zero conditional on the other asset. So intuitively we can add some random number, okay? Mean zero random number. It doesn't have to be normal, it doesn't have anything. Anyway, if we add a random number to original asset, then the other asset becomes more risky. So for example, we can create a more risky asset than Samsung electronic stock. Okay? So suppose Samsung electronic stock to create risky asset than that one, what we can do is, okay, we add random variables to the return on the Samsung electronic such that, for example, we can draw the coin. So if there is head, we can add $1 to the value of Samsung electronic stock. And if there is tail, we subtract $1. Okay? So the drawing the coin, the value of the either plus $1 or minus $1. Okay? That is random variable. Okay? Random variable means zero. And the drawing the coin is totally independent of Samsung underlying asset. So in that case, and we create more risky assets than the original one. So this is the most influential definition actually in finance and economics. By the way, so given this definition of risk, now we can prove that the rationally determined world price is non-decreasing function of risk with associated common risk. Okay. So non-decreasing function. So it's weekly increase. Okay. So if we add risk on the underlying, in the way we define the risk, then option value does not decrease. Okay, it is likely to increase. We can prove this part in next class. Okay. I think next class will be our last class. Yeah, next week is our last class.
Do you have class?
Yeah, so next week is our last class. So,
It's the same like midterm. We had in our final exam on Saturday.
I forgot, so let me check it again. So, the final exam. Final exam, so 20. Okay. So 3 days left to the final class. Okay, good luck and see you next week.